So you're Generation Z and maybe thinking about getting into the stock market? Here are some things to noodle over. First, though, don't feel like you've missed anything. All periods have runs and rocky times. You've missed some runs, but you've also spared yourself lots of grief. Consider if you started way back in 2000, would you be basking in the glow of your wise investment or nursing the wounds of a financial fiasco? In the world of stocks, the timeline from 2000 to 2023 reveals a roller coaster ride of ups, downs, and unexpected turns. 2000 was a year marked by the notorious dot-com bubble. Tech stocks were the talk of the town until the bubble burst like a pregnant tick under a match. It was just as messy too, minus the Lyme disease. Companies like Enron and WorldCom were caught in the storm, and their stocks crashed and burned like a blind dude on an off-brand electric bike with a bad lithium battery. Fast forward to 2008, the year of the financial crisis. This period saw a downturn in various sectors, with housing, banking, and global stock markets feeling the pinch. And no, Obama didn't lock up any of the big bankers. They did get nice bonuses, though, as thousands lost their homes. Bit of history. By comparison, during the late 1980s, the savings and loan crisis saw the conviction of over 1,000 bankers, even though the losses paled to the beating we took in 2009. In that crisis, poor management and corporate scandals rocked the corporate world. But this time, the regular people took it all on the chin. So yeah, be glad you missed that. Things bounded around a lot during the COVID years too, but it's not all doom and gloom. During the same period, some other stocks flourished. All hail the tech gods. Tech giants like Apple, Amazon, and Microsoft saw exponential growth. If you had invested $1,000 in Apple in 2000, you'd be sitting on a cool $125,000 today. As Matt Damon said in Good Will Hunting, how do you like them apples? And in recent years, power brands like Tesla and Netflix also made their mark, becoming household names and seeing their stocks soar. The stark contrast between the worst and best performing stocks is a lesson in itself. The former could have almost wiped out your investment, while the latter could have multiplied it over 100 times. And that's one reason many retail investors, which means us everyday folks, might want to avoid overweighting any stock portfolio with single company investments, but more on that later when we get to index funds. So, yes then, the stock market can be a wild ride with its share of highs and lows, but history shows us that though markets may tumble, they also bounce back, and they do so bigger than ever. Main point here, give up trying to time the market. Just jump in or go long. Certainly you want to avoid knee-jerk panic, because selling during a downturn can result in cementing losses. Understand that you've lost nothing until you sell. So hold and allow your stocks to bounce back when markets recover, because they will. Those with patience and a long-term vision, those who held onto their stocks, they can expect to recover and even make significant gains. There are hundreds of stocks, of course, and that can be daunting and lead to confusion that, well, leads to inertia. One solution is index funds. These are funds aimed to replicate and track a specific benchmark index, such as the S&P 500 or the NASDAQ. Index funds offer a simple, low-cost way to gain exposure to a wide range of stocks, making them a popular choice for everyday investors. By that I mean normal people who have neither the time nor the expertise to babysit their investments. Reputable products from companies like Morningstar, Vanguard, and Fidelity offer a variety of index funds, providing a way to invest in a broad market segment. Over time, these funds have shown consistent growth, making them a reliable choice for long-term investment. A case in point is the Vanguard 500 Index Fund, which tracks the S&P 500 and has grown an average of 7% per year since its inception in 1976. Here is maybe the most important thing for new investors to understand: the potency of consistent investing and compounding. Even starting with a minimal initial investment, the systematic addition of a modest sum can lead to astonishing outcomes. Whether you are buying shares on an index fund, or maybe you also own a few individual stocks like Tesla or Nvidia, the key is adding some each month, rain or shine, lows or highs. That way, not only do you benefit from adding to your portfolio, but you'll be averaging out those highs and lows. Where do you find the money to do that? Learn to skip a few lattes a week, or even if you don't splurge on that, we can usually find something to trim. And here's an idea that's quite literally not new: buy only used cars if you must have a car. And hang on to your old ones as long as you can. That $300 extra a month you might be able to invest by driving used cars will be worth hundreds of thousands when you retire. Finally. And some don't want to hear it, but lots of us want everything now. Delayed gratification may sound tired or trite, but it allows the miracle of compounding to work in your favor. The alternative is recognizing you are letting the banks and credit card companies compound against you. Take it from one who has learned those lessons the hard way. That'll really dump Dookie into your diaper. So be patient. Your generation is too smart not to take advantage of compounding, and the earlier you start, the better. I mean, isn't Gen Z all about working smarter and compounding is smart? For those of you just beginning your voyage into the realm of finances, bear this in mind. Our society is progressing at an astonishing rate. No one feels that more than you. You often feel crushed by harsh realities my generation may not have faced. But fresh inventions and chances sprout up daily, and today you have knowledge tools you can access the likes we crusty seniors could never have imagined. Advanced tools that are intuitive to you may be indecipherable to us, so fear not. And this all might appear daunting, particularly when it comes to devising your financial roadmap. But never forget that beginning with baby steps, maintaining a steady pace, and exercising patience can yield remarkable outcomes. All that's required from you is a little creativity to find a few bucks to begin with. Form a habit of that so you can consistently make a modest monthly contribution. Then watch the magic of compounding build your path to fiscal stability and prosperity. Just don't watch too closely or daily or even weekly. It'll make you crazy. Just start as young as you can, keep on investing, and leave it the hell alone for at least 40 years. Have faith in the journey, stay updated, and above all, possess patience. The future is promising and your possibilities are boundless.